Hello everyone. This is the last learning objective today. In this learning objective, we consider the application of discounted cash flow measures to come up with the valuation of shares. So as a starting point, we know that across all discount cash flow measures, the underlying theory is the same. The current price of an asset is a function of present value of all future cash flows. So the first question is, what are the future cash flows that we are going to use? What are the appropriate cash flows received by an investor? So one way to think about that is that given a firm has a theoretically infinite life, and if we can assume we have got a dividend paying stock, then dividends paid by the firm and the residual cash flows that are received by the owner of the firm and the infinite time series of dividend payments will give us the cash flows that investor receives. So the idea of the dividend discount model is to take the present value of that infinite series of future cash flows and use that as a measure of the price of a stock. You can see here in the formula, the value of a stock today is just each of those future dividends, for example, D1, D2, D3, and up to infinity. Each of those future dividends discounted back in terms of today's dollars. Now, two issues are obviously required here. One is we need an estimate of what these future expected dividends are going to be. And in particular, we probably don't expect that dividends are going to be constant through time because we expect stocks to grow through time periods. As the firm grows, the dividend payout should grow with profitability. Second of all, we need some estimate of the scale, the required rate of return. Often we use some sort of model like the CAPM to come up with the required rate of return for this stock. Once we have these inputs, we think the key principle is the stock price equals the present value of all expected future dividends into perpetuity. What are some models that we can use to actually be able to simplify the infinite stream of dividend cash flows? Well, we need to make some sort of assumption in terms of future dividends. The first assumption we can make is that the dividend is going to grow at a constant rate through time. So if we can assume that there is a constant dividend growth rate, that is G, then the value of stock today going to be D naught, which is the most recent dividend multiplied by 1 plus growth rate divided by the required rate of return minus G. Another way to express is D naught 1 plus G as D1. So D1 is basically the same thing, D0 at D0 multiplied by 1 plus G, because we are expecting that D0 will be growing at a rate of G. Now, considering the industry life cycle is important in valuation because the life cycle of the industry is going to affect our expectations around the future growth rate. If we have got a farm that's maybe in the early or high growth phase, we might expect dividends to grow significantly over a short period of time. But then as the farm matures, dividend growth has slowed out. If that was the case, we were trying to value one of those farms that we might expect to have multiple dividend growth rates through time. Where we have multiple dividend growth rates, the valuation model is slightly different. Basically, during the initial period of high growth, we would take the present value of each of those dividend amounts. Let's say that there was 3 years in which we expect the dividend to grow at a significant rate. We would take the present value of each of the dividends separately. Okay, each of the dividends separately and take their sum. We then use the third year dividend in our constant growth model. That is pretty much similar to the previous one because we expect that from year 4 onwards dividends are going to grow at a constant rate. As the firm matures, it will be unable to generate excessively high dividend. Finally, we discount the resultant valuation back to today's period. Now, when we apply our dividend discount model, there are some important implications that we can make. The dividend discount model implies that the stock's value will be larger when we got a large expected dividend per share. The stock's value will be larger when the market capitalization rate or the required rate of return is lower, and will also be larger when the expected growth rate of dividend is higher. The stock price is actually expected to grow at the same rate as dividends. So these assumptions are important. In this particular case, we are implicitly assuming that the dividends are the expected future cash flows of firm. So any growth in the dividends represents a growth in those expected future cash flows. A key question in terms of using the dividend discount model is that we need to come up with some measure of expected growth rate of the firm. So how do we actually estimate the G from our model that we looked at before? Well, there are a few different methods that we can use, but one way is by thinking about growth as a function of the profitability of the firm, and the proportion of firm's profit that are going to be reinvested. So on the screen, I have got a formula where the dividend growth rate is a function of return on equity. That's the return of the profit that is generated on each stock issued by the firm, multiplied by the plowback ratio. This B indicates plowback ratio. The plowback ratio is the proportion of the firm's profit that is retained within the company for reinvestment. Because we can think about the growth is the dividend, the growth in the dividend is a function of the growth of the firm itself, and we expect the firm to grow by the amount of capital investment that can be made through time. So capital investment is the profits being generated and reinvested in the firm, and that's what the formula on the screen is enabling us to come up. Now, when we are valuing our firm using a dividend discount model, we are coming up with a measure of net asset value. The value of equity in the firm, net asset value is the value of equity in the firm. What might be important to some investor is that if they have a total value of the firm, they might seek to decompose that into value of assets currently in place. This is what? And the value being placed upon the growth assets in the firm, which is here. As the growth assets in the firm is the expected future growth because of future investments, what we can do is we can use the dividend discount model as a way of coming up with total valuation of the firm. But then we can decompose the total valuation into these two components, assets in place and growth assets. So let's have a look at how we might do that. We know that we can assume that the price of a firm is equal to the both value of assets in place and present value of our growth opportunities. Now, with regard to the assets in place, we know how we can measure because that is the value of the firm if it is just remained as the status quo or if it is just continued to use its current assets. Or another way to think about that is it's the no growth value per share. And we can measure that as expected earning in perpetuity through time. So earning at the end of current period divided by K, this is what here is saying the next period's earnings are going to be continued in perpetuity for the firm. So what must be remaining in terms of our valuation here, the present value of our growth option, this part. By rearranging this equation, we can say that present value of growth options must be a theoretical value of the share price, that is P naught. And we can use the dividend discount model to come up with its value minus expected earnings in the coming period divided by the required rate of returns. Now, the key in terms of estimating any form of growth is always getting an accurate estimate of the growth rate of the firm that we spoke about before, or to use what's known as the Wall Street rule of thumb. This rule identifies that the growth rate is roughly equal to the price earnings ratio of the firm. For example, if the PE ratio of Coca-Cola is 15, you would expect the company to be growing at about like 15% per year. Okay. And you can see here the P ratio of different industries in Australia. For example, for industrial, it's about 10, whereas for healthcare, it's about 20. So as the P ratio for healthcare is about 20, we can expect on an average a 20% growth rate of these firms. Whereas, for example, materials has an average growth P ratio of 15. So we can expect that these firms will grow at an average rate of 15%. Now, an alternative measure that we can use rather than the dividend discount model is the free cash flow valuation model. The formula for the free cash flow valuation is exactly the same as our dividend discount model. The only difference being the future cash flow are the free cash flows here as opposed to dividends. So it's the same formula, but instead of having dividend, we have free cash flows. To apply this formula, we still need G, so we still need some view as to the extent to which the farm is growing, because we use that as our estimation of the extent to which we expect this free cash flow to grow through time. Now, as a concluding discussion, couple of important points to know with respect to using valuation techniques. We know that discounted cash flow valuation models are based on three inputs: cash flows, the required rate of return, and growth rate. It's not possible to estimate any of these with 100% accuracy. So what we need to do is we need to justify each input to undertake careful evaluation as to what the inputs are and where they come from. But more importantly, often we might need to use some sort of sensitivity analysis where we test what our valuation would be under different scenarios relating to each of these inputs. This gets back to our idea of valuation that we spoke about in a previous video, where often with respect to valuation, although we want to come up with a point estimate, but we actually come up with a valuation range. So our sensitivity analysis might be used to come up with that range. So our point estimate might be based on our best possible inputs with respect to our forecasted cash flows, required rate of return, and growth rates. But as we vary some of our assumptions with respect to these inputs, we get a range of possible future valuation prices. That's the end of our discussion this week. Thank you very much.